You're listening to Legends, a RenMac podcast with some of Wall Street's most influential minds. I'm Jeff DeGraff. Today we're talking with Stan Weinstein, famous newsletter writer and author of the 1988 book Secrets from Profiting in a Bull and Bear Market. Stan is an old-school tape reader. Before the internet, Bloomberg's, Quotron machines, Stan used Mansfield charts and found his way to listening to the tape and developing a process that identifies 4 important stages in a security's life cycle. Here's our conversation. Stan Weinstein, thank you so much for joining us. Stan, you're a professional tape reader. That was the name of the newsletter that you penned from 1972 to 2000. Now the editor of Global Trend Alert, which you've been at the helm of since really 1990. And then you're also an author of a very good book, Secrets for Profiting in Bull and Bear Markets, which was written in the late 1980s. So 50 years as a technical analyst, you've seen a lot, you've experienced a lot, you've learned a lot. But one of the things that you said in your book that I really thought was interesting and still feels like it holds as much water today as it did back then was a saying that you had that said, the tape tells all. Will you tell us what you mean by that?
Absolutely. And first of all, I love the synopsis you did. You've done your homework A+, and I don't believe in great inflation. Basically, even though most people don't know I have a degree in economics, I learned long ago to put my degree on the side and the fundamentals on the side and to understand that at the end of the day, it's really all supply and demand. And I know you know this, and I'm not telling you have to put your fundamentals on the side, but you have to understand that although they may be the engine that's pulling the charts, it's really a tug of war each day, Jeff, that's going on in the market. And when you see who's winning the tug of war, to me, that's the ultimate reality, and it's much more important than the news. And what people don't realize, a lot of times when the news is very, very good, and people are buying stocks, it's already discounts that news and the stock has run up already and it's at a top and making a top and rolling over. And conversely, the news could be terrible, stock could be at a bottom, starting to digest the bad news and it no longer goes down. That's a positive signal. So truly, at the end of the day, the tape does tell all.
So I think you coined as well, today's price equals tomorrow's news.
That's true. And what's interesting, even fundamentalists forget this too often. You learn in Echo 101 that the market is truly looking ahead and is a discounting mechanism. And that's why it's a mistake. People think, oh, I've got to read what's going on in the Wall Street Journal, this and that, and they buy off of that instead of realizing that the good news on a rising stock may have already been discounted, and conversely on the bad news on a stock that's declining, that's then no longer going down.
Yeah, those narratives can certainly be dangerous business in this game for sure. So let's rewind the tape here a little bit and go back to that economics degree. You get an economics degree, and it sounds like your path is very similar to a lot of technicians, which is nobody went to technical analysis school. They came out with something else, and then whether through good fortune, misfortune, or just street smarts said, hey, there's something more to this than chalkboard and theory. And how did you sort of trip your way into technical analysis from an economics major?
Okay, I'll give you a quick review, and here we go. First of all, playing the market, but I really didn't know what I was doing to any great degree. In the early 60s, and in 1962, we had a crash after Kennedy had confronted Steele, but there too, which I didn't know at the time, the market was actually making in March and April of 1962 a head and shoulder top and broke down, and I lost all my bar mitzvah money. So I thought, there must be a better way. And again, it was fortuitous. At that time, I went into the school library. I went to Hofstra University, and I saw this book, and it was sticking out to me. And I wasn't even looking for it, but it was almost like a godlike thing. And it was McGee and Edwards' Technical Analysis of Stock Trends. I read the book. It made sense, even though it was a little difficult to read. The points were well taken, but I then got a new stipend from my mother. I started playing the game again, and I suddenly was doing better and not losing money, and there was something to it. So I think that Vinnie Lombardi, who wrote in his book, which I think has validity for life as well as sports and the stock market, he says in an average football game, there's 72, 73 plays, but it really comes down to maybe 5 plays plus or minus that win or lose a game. And I think it's the same way in life.
And you started out as a broker, correct? So not even in research, you meandered your way into research. Tell us how you found your way into the professional tape reader and the like.
Okay, so here we go. There's no guarantees in life or the market. Only the liars are always right. But I think what makes a successful market player as well as a good, successful life is always measuring risk reward and then taking a good value judgment after you're weighing the upside versus the downside. And again, if you make the good judgments, you're not going to always be right, but I think you'll be right much more than you'll be wrong because you're playing the good probabilities. I made important play number 1, decided to turn down the safe job and became a stockbroker, trained $75 a week, brown bagged it. That was important play number 1. Important play number 2, now I'm a stockbroker, market crashes in 1969. Happily, I had gotten clients into T-bills in those days. Now things are slow, and I then answer an ad in the Wall Street Journal, which it was just P.O. Box. I didn't even know what I was answering. That said, hey, they're looking for a chartist. Several weeks later, I got a call, and when I got this call from the owner of Indicated Digest, play number 2, took the job at Indicated Digest, eventually became the editor of Indicated Digest and another publication called Technical Stock Reports, editor of that. And also while I was there, met Justin Mamus, who was a terrific technician. And the two of us worked a bit together. Justin actually left Indicated Digest in 1972, started the professional tape reader. Then I, a year later, decided, I want to start a market letter because now I had learned not only about the market to a greater degree, but also the promotional game of a letter writer. And I started, writing ads for Barron's, whatever. So anyway, Justin said, well, don't start your own letter. We could work together. Came in, became a partner with Justin, 50-50 partner. We had very few subscribers at that point, but together we did a great job. Caught the 73-74 granddaddy bear market. Boom, got national attention. The tape reader grew. Then next important play for me, 1976, I bought Justin out and moved to Florida and gained national attention to a greater degree at that point. And then I guess thinking back, important play number 4 for me would be in 1987, wrote the book, which you alluded to, and that got us even more attention. The final important play number 5 for me was a guy came along who said, hey, I know you're very successful with a professional tape reader, but I think you could do even better with an institutional service, which I started in 1990, Global Trend Alert. I love the challenge of the market. Let's see, in 2000, I retired the professional tape reader. So all I do now is Global Trend Alert and talk to professionals like yourself.
Well, and here's important play number 6, talking to RenMac and the legend. So Stan, thank you so much for your time. I do appreciate it. Let me tap some of those brain cells from 50 years ago and see if you recall or, what it was in 69 that had you alert enough and nimble enough to get your clients to get into treasury bills and out of harm's way. Was there a sequence of events or something that really sort of hit you over the head and said, hey, this is a dangerous tape?
Yeah, you're spot on. And I think that it really starts to come into the present, even though I'm not a long-term bear yet. I'm starting to see some early warning signs. Let's go back to your question, which I think is a fabulous one. In late 1968, going into 69, before you even got to the charts where many stocks were starting to top out, we had a tremendous speculative bubble. In those days, there was stocks you wouldn't know now because they long ago disappeared, but like National Video, which had gone from like a low few dollars up to like $400 or $500. It was ridiculous. There were other ones, Cameo Parkway, which was just a simple record company where Chubby Checker, who's still around, had hits on, and the stock had gone from like $1, I don't remember, up into maybe mid-60s, and then it was rolling over. It was tremendous speculative time, scientific data, incredible stocks, did wild things. They only went up every day. They were never going to go down. So that was warning number 1. Then number 2, when you looked at charts, you started to have a lot of head and shoulder tops form on individual stocks, and then boom, as you went a little bit further into 1969, it broke down, and 69 into mid-70s, you had a debacle there. very bad bear market. And now coming to today, which I was starting to tie it into, while don't get me wrong, I'm not telling you, oh, we're ready for a crash, in no way. But I've been writing and advising with clients I speak to that we now, and I know you're on top of your game, we're in a split two-way market at this point. You're starting to, first you've had the speculation where you had stocks like GME that had gone just a few dollars up to ridiculous numbers. You had other runs in speculative stocks. You have the crypto phase, which now they're finding, these things can go down as well as go up. You've got tremendous speculation going on. And I keep up something called my speculation index, which we measure each week, OTC volume vis-a-vis New York volume. And a few weeks ago, it reached an all-time high over 770%, the highest in the close to 50 years that I've been keeping up this gauge. That was a warning. And even though now it's come down somewhat, it's a little under 500%, it's still very high. So first, you've got the speculation going on. Now, the second thing, you now have a two-way market where, while we're still bullish, so don't get me wrong, I'm not a long-term bear yet, but I've told people what's more important right now than getting hung up on bull-bear semantics is to understand that you're splitting it off. Less Indians are following the chief up the mountain. And what's going on now, we put out a sell many weeks ago after the mid-March peak on a lot of aggressive growth stocks, and they've gotten killed. A lot of those stocks are in their own private bear market, while at the same time, we've switched to value, and a lot of blue chip value kind of stocks look just fine to me. But you're definitely, as I've been writing, thinning out the herd, and that's a warning. What most people don't realize, whereas market bottoms, like we gave a buy in late March, early April of 2020, after you had that terrible February-March crash, it's a monolithic affair. V, boom, they almost all made their bottoms together. But a top is different. Tops are usually a matter of taking one stock at a time out and shooting them and losing them. And that's what's currently going on, where, hey, there's still, don't get me wrong, there's still some bullish charts, especially in the quality area. But in the aggressive growth, oh my God, I'm sure you've seen it on your charts, they've already slaughtered so many of these stocks. So you've got to know that the process has started. And while I'm not a long-term bear, again, don't worry about getting hung up in bull-bear semantics, as I said earlier. Instead, understand stock A, which could be, let's say, for argument's sake, in materials, oil-related. I'm bullish on gold. Those are still fine. At the same time, the go-go stocks, they're running into trouble.
And it's fascinating when you talk about 1968 and 1969 and some of these names, because we've coined a phrase we call concept finance, right? Which is, these are great ideas, but can they really execute, and are they viable businesses? And it sounds like the go-go years, and there's a great book, which I'm sure you read, called The Go-Go Years, that talks about some of these very similar types of securities that sounded great and were technology of the day. But as we look back 50 plus years later, we can sort of laugh at it and say, that was technology? That's, come on, that's nothing. So you too see the similarities between some of what we've seen today and the go-go years of the late 1960s.
You're so on top of your game, 100%. And there's that old joke, but there's some merit to it. They say history doesn't repeat, but it rhymes. The bottom line is history does repeat. And, we think that we're so sophisticated and we wear different clothes and that. When you really go back, at the end of the day, human nature is human nature. And when a stock is going up, we think it's going up forever. When it's going down, it's going to zero. And supply and demand doesn't change. So the bottom line is, yes, if you go through cycles, and of course there are some differences, but there really are incredible similarities. After that 69-70 debacle.
The Go-Go Years was released in 1973 from author John Brooks. It's a fabulous history of not only what was happening in the markets, but importantly, it weaves in the social construct of the day, which becomes such an important part of any Wall Street era. Michael Lewis, in 2014's re-release of the book, writes as a review, quote, "The Go-Go Years is not to be read in the usual manner of Wall Street classics. You do not read this book to see our present situation reenacted in the past with only the names changed. You read it because it's a wonderful description of the way things were in a different time and place." End quote. In 2014, I would have agreed with Michael's assessment, but today I disagree. The go-go years is so harmoniously tuned with today's market, with the obligatory names changed, of course, that it makes it a must-read, an indispensable user's manual for a different version of the same machine.
Then what was interesting, we had another bull market there from mid-1970 that lasted into 1973. But in 73, now the game actually changed. And this is why you always got to be ready for these splits. And that's why I don't like when markets start to become fragmented. In 1973, the advanced decline line, which most people don't realize, actually topped out in the spring of 1972.
For those not technically inclined, the advanced decline line, colloquially known as the AD line among practitioners, is the cumulative sum of the difference between the daily number of advancing stocks and declining stocks. It will often deteriorate well before a top formation. It is the duct tape in the technician's toolkit. Simply indispensable.
But go-go stocks of that year, what we called in those days the Nifty 50 stocks, Avon, Xerox, Polaroid, etc., which most of them are not even around today, although Xerox is. Anyway, they continued to move higher. And although the Dow actually topped in early January of 1973, and the AD line had topped out well before that, the Nifty 50 continued moving higher into, well, some topped out in April, May, some went into June of that year. But you had the tremendous fragmenting, which is starting to take place now. You had this tremendous fragmenting going on. And what was very interesting, again, to allude to something you said earlier, it shows that history doesn't really change, because in those days they called them, and this is the ultimate, even though contrary opinion was a part of my game, the ultimate contrary signal. They named those 50 stocks or so of those days, they called them one decision stocks. Can you believe it? One decision. They said all you had to do was buy them. You never had to sell them. And if that wasn't a contrary opinion, and the bottom line, they then wiped out all of the Avon, Xerox, Polaroids, disaster. So yes, the game remains the same. We just have different players in the game.
Yeah. And, one of the things I think you've done, and I want to give you a ton of credit for this, because I think it's really important, not only for the professional investor, but even the amateur investor who wants to get started in technical analysis. You took some of the work from Edward and McGee, and I think really refreshened it and brought it up to speed in the late 21st century with your book, Secrets for Profiting in a Bull and Bear Market. And one of the ways you did that was simplifying the process. And I certainly don't want that to sound insulting, because the simplification is really very elegant and important. But you walk through these stages, stage 1, 2, 3, and 4, using, I think at the time it was a 30-week moving average, and sounds like now you use maybe a 200-day moving average. But let's talk about these stages, because I think it's important for investors, whether you're a professional or amateur, to understand these different stages and the characteristics, because there's so many similarities that you define so well in these stages. So I'm in stage 1. What does that look like to Stan Weinstein? How do you describe and define stage 1?
Here we go again. You're doing a great lead job. So here we go. Let's say the stock has had a big fall. We'll use imaginary numbers. The stock has dropped from 30 down to 10. Now, people want to catch the exact bottom. I don't even want to catch the bottom, because our studies have shown over the years, even though the game is being played, Jeff, a little fast these days, as you well know, that even if you catch the low tick, there's a lot of base building that has to be done. Just like when you build a house, there has to be a foundation. So too, when you want to have a big move in a stock, you have to first have a stage 1 base. You have to have a foundation. So you don't want to catch exact low. So the stock has dropped from 30 down to 10. Now it starts to fluctuate. Let's make it simple, between 10 and 12. Now, I have, as you said, the long-term moving average, and the two moving averages I like at this point in time, but it's the same concept, is the 200-day moving average and the 50-day moving average. Now the 50-day is for shorter term to intermediate term playing. The 200 is very important long term. So the stock is, let's say, vacillating between 10 and 12, but if the 200-day moving average is still declining, and maybe it's only down to 15, you're still early in the base building process. But maybe now it's many weeks later, and you're still building this 10 to 12 base, but now the 200-day moving average is down to, let's say, like 12 and a half. Now you're really ready to talk turkey because you want the base and the long-term moving average to kind of get close to each other. And then, boom, you break out above the resistance at 12. You move above the 200-day moving average, which is at, let's make believe, 12 and a half. You've completed the stage one base, which is the preparatory area that you want to do initial long-term buying.
This is the place where value investors should be leaning into positions. Let the other guy buy on the way down, experience the portfolio drag of opportunity cost, hoping to catch the last puff of a cigar butt. As the stock starts to break out, it may not be as cheap as it was at the ultimate low, but the breakout is a reflection that the market is starting to recognize the value inherent in the security, and often the name will remain of value as the company's prospects improve with price.
And now it goes into stage two. Boom. This is when you go pedal to the metal and your risk reward is tremendous and you go for it. You're now in stage two. And do you want to go further into 3 and 4 or not?
No, I want to stick to 1 actually. So let me ask about a couple other characteristics. You've got important volume signals on that breakout. Is that correct in stage 1?
Absolutely. Yeah. Absolutely. So when you break out, and now as I wrote in my book, not all breakouts, just like eggs, they're not all of the same quality. When you break out, if there's no increase in the volume, you got a good chance it's a false breakout. And if it doesn't work, fine, you get out. The ones that usually work the best is when you break out, you get a big increase in volume. And I like to see at least 3 times normal volume, and the more the better, the merrier the case. So that's a very important signal that you're now moving into stage 2. And I would say, because another question I'm often asked is, well, how do you know if it's a false breakout, and how and do you handle it if it is? So I say, fine. If it breaks out and the volume doesn't come in, A, there's a good chance it's false. B, even if the volume does come in, but let's say it breaks out above the 12 and a half area, and then suddenly it reverses and does a U-turn and comes back into the base, into like, let's say, 10 and a half, 11. False breakout, it shouldn't have come back below 12. I start to do reducing, and if it ever breaks below the bottom of the base, below 10, then forget it. It's totally goodbye, and it's false. And the next question I'm often asked is, what percentage of those breakouts turn out to be false? And it's usually a small percentage, but I would say roughly 10 to 15% at worst. So if you have a batting average where you're right 8 out of 10 times, you're in great shape.
Yeah, absolutely. And how about just 2 other characteristics, one being relative performance? How important is relative performance for the security? And then also, how important is it that the group is acting well as you see this breakout take place, or is it inconsequential to you?
Oh, no. Again, you nailed it. First, relative performance is important, but to me, even more important, and I wrote in my book about that, and I've since refined it since many years ago, that group agreement, I call it on the upside and the downside, guilt by association, is very, very important. So, as I said in my book, if you have 2 A charts, they're both good, but one is in a less than thrilling group and the other one is in a hot group that's working. And it's even more valid, Jeff, today than it was back in the 80s when I wrote the book, because you now have, well, I guess for lack of a better word, you have a lot of non-thinking players. And when a group breaks out, they go A to Z. And when a group breaks down, they sell everything. The heck with the fundamentals or whatever. So the group performance is so important. And even then, when I wrote my book back in 1987, 88, that if all things were equal, you have one in a very good group, go for the one that's in the hot group. It has a far better chance of being a big winner than if it's just a so-so group. And now I believe it's even more valid, because, as I said, people today are just following computer A to Z. They've got all their programs written, and if a group gets hot, they go from top to the bottom of the barrel.
Our work confirms the importance of both relative strength and group strength. It's just so hard to excel in a bad group as to not be worth the effort. Whether that's the overarching macro environment, sentiment, whatever, we find that the stock's performance is 40 to 70% attributable to the group to which it belongs. That, of course, depends on the point in time. But get the group right, and you're automatically a C plus to B player.
Yeah, absolutely. And when you look at then stage two, and I do want to get back to one thing on stage one, but we'll do that later. When you look at stage two, that's a nice sort of persistent trend. I presume volatility is contracting for the issue. What are some of the other characteristics in stage two?
Okay, well, we all know, even though everybody likes to see their stock go up nonstop, there's going to be corrections along the way. So a really healthy stage two move will have the corrections, and here's where the 50-day moving average can help you. They'll come back and usually hold darn close to the rising 50-day moving average. If it starts to violate the 50-day moving average, my game plan, and I'm sort of robotic, you don't have to blow the position, but I immediately reduce the position. Those that act like obedient children, and boom, the corrections hold above the rising 50-day moving averages. Also, as you well know, when you're rising, you're moving ahead, the volume is increasing and it's strong. But when you're correcting, you want to see the volume contracting so that sellers aren't bashing the heck out of the stock. Those are all healthy stage two signs. And where I would change a bit from what I wrote my book way back when, you know that today, we're dealing with markets that are moving at warp speed. So even when you're in a good, healthy stage two move, whereas in the old days I would say, hey, if you're an investor, just write out the corrections and da-da-da-da-da. I have clients now, and I'm not talking about every little wiggle and jiggle, but now if you get extended and you see you're going to correct, I think it makes sense. I'm not talking about blowing a position, but taking 20, 25% of your position off, and then you'll feel relaxed and you buy and sell to the sleeping level, because the moves that we're getting now and the volatility we're getting now is something I've never seen in my 50 plus years of market playing. And trust me, because I talk with a lot of mutual fund guys, a lot of hedge funds, and even those clients who tell me, Stan, I'm long term, they know that with the kind of moves and the shakeouts we get, that they want to take some chips off, because anybody who's playing these days knows that you want to buy and sell to the sleeping level. The sleeping level can be very uncomfortable when you get some of these sharp shake the tree moves.
Stan calls it the sleeping level. Others call it heat in the kitchen. It's different for everyone, but it's essentially the level of risk you're willing to have on, or more precisely, how much you're willing to watch the value of your account disappear. It's important because once you breach this sleeping level or experience too much heat in the kitchen, your emotions are likely to dominate your decisions, and that often leads to the worst types of decisions in this business.
And what do you think the biggest risk is, just in your experience with stage two? What's the biggest risk to equities or any security that's in stage two?
I don't know that there's really a good answer to that question. I guess the biggest risk is a short-term risk, that because sometimes you get a tremendous move on the upside, and if you get, I guess to answer your question, the best way I could answer it, common sense, which when I used to be on the seminar circuit, I would say common sense is a rare commodity on Wall Street. When you see that you've gone so far, like you've doubled the 200-day moving average. Let's say you broke out, like we use that analogy, at 12, 12 and a half, and the 200-day moving average is there now 12, 12 and a half, 13, and the stock has shot up, way up. It's doubled the moving average, 100% above it. It's like 24, 25, and it's even well above the rising 50-day moving average. You don't have to be a technician or a genius to know, like, ooh, I've got some risk. So profit taking, in my opinion, is never a dirty word. And you're so extended, I think you got to be ready for any signs of short-term churning and take some off in extended stocks.
So we're in stage two, and now we're transitioning to stage three. What does that look like?
Okay, here we go. Whereas in stage one, and it's not always going to be, picture perfect, but when we're in stage one, very often, and I know you know this because you're a sharp professional, as you're building this base, the news is less than thrilling, and you start to get some bad news, and the stock is no longer going down on the bad news. That, to me, is a buy signal. Well, conversely, to answer your question, now you're in stage three. There's a reason why the stock went up, okay? Usually now we'll find out, hey, the news is good, and people are first discovering the stock, kind of like happened with the Bitcoin recently when I had clients selling it. When I first started to sell many months ago, people didn't want to hear about Bitcoin. Then it became the flavor of the month, and boom, it had the terrific rally up, and there was all kinds of news and whatever, good news, and it's going to go up forever. Anyway, it stopped going up. It started rolling over, and often this will happen with stocks where the news will no longer take it to new highs, and it'll usually be a sequential process, Jeff. First, it doesn't go up on good news. Secondly, early warning, even though you're still above your 200-day moving average, you start to break below the 50-day MA, and you may, which often happens, whip back and forth a couple of times through the 50-day MA. You're starting to run into trouble. I do reducing. You're in stage 3, and then ultimately it hits the destructive stage 4 when you break below the support and the 200-day moving average.
And again, volume important there or not as important?
No, that's less important. In the old days, you used to want to see a pickup in volume, but now I would say stocks can fall on their own weight, their own volition. So sure, if it's classical and you're breaking down and the volume picks up, yeah, that's important. But whereas on the upside, you want to move from 1 to 2 on volume. If I see a stock breaking down, even if the volume is not picking up, I shoot first and ask questions later. I've seen plenty of stocks fall of their own weight without the volume picking up.
And then stage 4 is obviously a break from that trading range, whether it be a double top or a head and shoulder type of top, and volume not that important. Have you found that relative performance tends to lead the absolute performance to the downside? In other words, will I get a breakdown in the relative performance first and then from an absolute performance?
Again, good question. Many times, yes, but sometimes we can start. I always kid around with that KISS, keep it simple, stupid, not that we're stupid, but the bottom line, I always, when I was on the seminar, I tried to tell people, you can come up with so many thoughts and you can start to confuse yourself with plus minus things. I try to keep it straightforward. So yes, good point where you said that's another little bit of whipped cream on the cake. But to me, if you see, as we've described it, let's use numbers. The stock now ran from 10, it broke out at 12.5. It's gone up to 30. And now it's rolling over between 27 and 30, no longer going up on good news. It's breaking back and above its 50-day MA. But the same way as we did on the downside, initially the 200-day MA may only be up to, let's say, 24. So we're reducing, but we're not yet out. Now, maybe it's 2 months later, and the 200-day moving average is now up to 27. And that, not so coincidentally, is the bottom of this floor of support. And another important thing, you start to see the moving average flattening out. If the moving average is still rising, it probably 200-day MA, you're probably still a little early. But now the 200-day moving average is flattening out, and you break down, forget it. I'm not going to overthink this. I'm out of there. And then, of course, again, putting the cherry and the whipped cream on the cake, if you also have a negative group, I'm selling it irrespective, but if you have a negative group, and especially you start to see volume like you alluded to before coming in, now it's not only to me a sale. I think, when the group stinks, I think we start to look to short it. That's what we did in the last 2 months on a lot of the aggressive growth stocks.
Yeah, you said something earlier, which I thought was great, which is at the turn of the year, you could do no wrong, right? Every recommendation was a double or a triple, maybe even a home run, and there were just no strikeouts. And that in and of itself, the sweet, sweet taste of success is in many ways an indicator by itself, right?
I think you are so spot on. That's true, because you know your stuff. If you take a look from when I gave that intermediate buy, which was in early November, into mid-March, it was just like shooting fish in a barrel. And it was so much fun to come into the market each day here into the office. And you could, like you say, you could do no wrong. And it's funny that I had said to my wife, Rita, at that time, I think, I'm a little concerned because I've seen this movie before and I know the last reel doesn't end so well. When you start to get that genius feeling like you're alluding to, and I know that I'm good, but nobody is a 10 for 10, but suddenly you're in a 10 for 10 zone where you can do no wrong.
We don't talk to many people who were around in the melt-up in 1982. Certainly, there are a few that still are there, but that you were really prescient in that, in making that call. And I know there was some friction between you and Joe Granville, the old-timer Joe Granville. What was it in 1982 that caught your attention and gave you an early signal in terms of your bullish recommendation for equities before the August advance?
Right. Okay, here we go. Again, I don't want to be self-serving because understand nobody's perfect, but it followed the textbook perfectly. It's what my theory is all about. And this is when Joe and I, who had both correctly called the 81 into the summer of 82 bear market, we had both been negative, fine. But then in July of 82, I have what I call, in those days I called it my NYC survey. Now it's my S&P survey, which is the percentage of S&P stocks that are bullish, as well as I have a separate survey, secondary survey, the percentage of secondary stocks that are bullish. But anyway, the market was going down, but in the June-July period, while it was going down, instead of this gauge falling, it was actually starting to base and improve, which showed that beneath the surface, there was starting to be technical improvement, and less stocks were now following the market lower. In the same way, the number of stocks hitting new yearly lows were starting to decline. Some good shorts were starting to form. So as history turns out, it was sometime in mid to late July, I went on Paul Kangas, may he also rest in peace, nightly business report, and I said, he asked me, Stan, have you ever been bearish? Are you still bearish? I said, no, Paul, I just this week put out a buy recommendation on the market. I think the bear market is ending. As things turned out, it was actually 3 weeks premature because they had one more hit into early August, and I had a tight feeling in my stomach. But even when we came down, I can still see it now. I don't remember, it was August 6th, whatever. It was sometime in early August. I remember Henry Kaufman had then put out a buy signal on bonds or whatever. Well, anyway, the market turned tremendously. What people thought it was all because of Kaufman. No, the market had really been doing its preparatory work. And at this point, Joe and I diverged. Granville said Weinstein is the ultimate bag holder, and he stayed bearish for the next 2 or 3 years. And happily, we turned out to be right. But it isn't to be a wise guy. To me, I'm always ready to be wrong. On the next uptick or downtick, I never argue the market. Those people, Jeff, who say the market is wrong and it's got to get in gear with me, are going to get destroyed. I know whenever I deviate and the market's not doing what I expect, I've got to re-examine it. I'm the one who's going to be wrong. The market is the ultimate arbiter. The market is never wrong.
Yeah, if you go against the market too long, you'll be lucky to have a bag to carry, I would say. That
well spoken.
So when you look at the stages, right, you talk about 1, 2, 3, 4. And again, I think that simplification is just so important to put in people's heads. And just to clarify and define what this looks like, how do you think about V tops and V bottoms? They are the exception to the rule, but they do occur frequently enough that we have to have some consideration. How do you think about V tops and V bottoms?
That's another great question. Yes, you're right. And even though that's the minority, you've got to be ready. And this is why you can't swing by one branch. You have to have all your ammunition on the tree ready. So a perfect example of the V bottom that you're alluding to took place when we called, happily it turned out to be right, that bottom in the March, early April period of 2020. After the market had gotten slammed, boom, you had a V bottom, and there were a lot of hints, again, because so many stocks all turned together. If you just have the market, have a rally like we've had, this week, the market rally, but there's a lot of stocks that are not following the market here. That's not going to be the same kind of a rally. But when you have stocks all together start to move in unison with a sharp V, that matters. It's the same thing if you get a V top. And even though these formations are rare, you still have to be ready for them and watch, and without going into so many different ways to look at it.
Most people want to have some contrarian instinct in this business, and V bottoms and tops are usually where consensus thinking becomes infectious and dangerous. We find contrarian thinking works great for V bottoms, while disruptions in credit conditions are often present around V tops.
But again, if you just use common sense and you let the market truly talks and you learn to listen to the message of the market, I'm telling you, Nothing in life is perfect, but you can have a good batting average.
Well, you must be an excellent listener because you've been married, what now, 60 years?
Close to.
You have to be a tremendous listener. So congratulations to you on that. You had a few things in your book on what not to buy, and a lot of these we've covered, but a couple I think are really great. Don't guess at a bottom. I think that's so important. One I think is interesting and important for you to flesh out for us. Don't let good stocks subsidize the bad ones.
Oh, that's so true. And I see this without naming names. Even a lot of the very smart professionals I deal with, you've got to take your ego out of it. We all hate to be wrong, but I remember writing, I don't remember what chapter it was, remember chapter 7, 8, whatever the book was a lot of days ago. But anyway, I wrote in there, I remember writing the words, and I had a chapter on how you deal with losing positions. And I remember writing this sentence, something to the effect like, how you deal with losing positions will determine how big a winner you're going to be in the stock market. You got to understand, we're all going to be wrong at times, but it's how you deal with being wrong. And this is so important, what you brought up, Jeff. This is so darn important. And like I said, I've seen it even with a big name who the guilty remain nameless. But anyway, they don't want to be wrong. So they go into that old BS about, hey, if it was a good buy at 50 and it's a better buy now at 40, and they average down. And then, if it's a better buy at 40, now it's 30, I'll buy even more. It must be better. I have the exact opposite take. I, first of all, never, ever will average down on a losing position. I want to buy, as I said in my book, I started the first few pages of the book. I remember writing the words saying, I don't want to buy low and sell high. I want to buy high and sell higher. I want to buy health. And going back to the losing position concept, if something isn't working, as soon as I go into a stock, let's say you buy XYZ, it broke out at 50, you think, this is going to be a great stock. But before I even buy it, I say, if I'm wrong, which believe me, has happened more than a few times in life, if I'm wrong, where am I going to call it quits? So if you say to yourself, okay, if it broke out at, let's say, 50 and a half, if it starts breaking back, let's arbitrarily say below 49, that's not really healthy. I'll do a little trimming. Then if it breaks, maybe the floor of support was at 47. If it breaks below the floor of support, I'm gone. Boom. The first loss is the best loss. I'm out of here. I'll never average down a losing position. Conversely, I think winners do the opposite. If you buy XYZ breaking out above 50, and it quickly ran up to 58, you go, and the volume came in, that's terrific. I know I'm right. Yeah, it may take a chip or two off because it had a big run up, but now as it pulls back, and it's really good if it doesn't even pull all the way back to the breakout of 50, maybe it comes into the 50-day moving average, which is at 52, we'll make believe at this point. Hey, and it holds, and the volume dried up. I want to buy more as it comes in. I want to average up in a good situation. I want to get the heck out of a bad situation because, as you said earlier in this question, which I think is a fabulous thing, I've seen so many people that, hey, they've got 6 or 7 great winners in their portfolio, and they got some real bad stuff. And to me, each dollar and each position in your portfolio should be pulling its weight. And again, going back, because I'm a crazy sports fan, if Jeff Stan is running a football team and you want to get to the Super Bowl, you don't get there by saying, well, I've got 5 good players on the field, but the other 6 are just so-so. You get there by each position of the 11 guys on the field. You want to have the best darn guys on the field, and it's no different when you're running your portfolio. And that's why, to me, it's criminal to subsidize good and bad and say, okay, well, this isn't working, but at least A is working, so I'll see if B later on comes on. I want everything to be an A-plus winner.
Yeah, I thought you had a great line, which was act as if each position is the only one you have, right? So as if it has to pull the weight, and there's just no opportunity for it to sleep in, as I like to say.
Well spoken, and I can't tell you how many people violate that. And again, that's just good tactics, and this is what people don't understand. I don't care, even if you want to be a fundamentalist, a technician, the concept is the same. Each dollar should be working for you.
And then that hits a little bit on diversification, right? So easy right now, we can look at material names, we can look at energy names, we can look at some financials, all breaking out, all transitioning from stage one to stage twos over the last 6 months at varying degrees. Probably not as important there because there's three different groups. What do you do? Or let's say you're a short seller and right now the short du jour, clearly the names that are breaking from stage threes to stage fours are some of these concept names. How do you think about the diversification and making sure you're not too loaded up in let's say energy names, because they are the ones that seem to be hot, and you're not too short, say, the application software names, because they seem to be the coldest here. How do you think about that?
Again, another great question. Diversification is important, and some people carry it to a ridiculous extreme. I've seen guys and gals that can have 100 positions. There's no one magic number. And then there's a few accounts I deal with that they really swing for the fences, and they might only have 3 or 4 positions, which if they win, they're going to win big, or if they lose, I don't have to tell you what happens. To me, I think, again, common sense, but each person has to buy and sell to the sleeping level makes a lot of sense. So I would think that, maybe having 10 or 15 positions diversified are good. Then you're right. Like right now, I think that the bank stocks look absolutely terrific. And my buy list is loaded with banks and some oils, which are going to pull back, but they look good. And even in oils, it's interesting. This is how diversified this market is. The oils look okay, but like the oil storage stocks look even better than the straight oil stocks. I mean, I've never seen a market that's so, you have to be at the top of your game. You have to be so disciplined that it's so defined. It's unbelievable. But anyway, so you don't want to just only have oils, or you don't want to only have my gold stocks, which I think are correct near term, but I'm going to buy more as they come in. And you don't only want to have some of the industrial stocks I like. You do want to hedge it out. But you also have to do, again, coming back to our common sense, Jeff, when we were in January, February, going into March, and everything was working, fine. You want to be fully invested. I think it's, again, common sense is a very important thing. I am not as heavily invested now as I was, say, in January or February. So I treat my own money like a hedge fund, and the people I advise, they do the same thing. I keep a little more cash now than I would have had in January. That's number one. Number two, I have a few more shorts than I would have had in January. And then even in the short thing, which you brought up, which is very valid, I don't want to only have the tech, although the tech is wonderful at every rally is short, but there are some other stocks rolling over, like I've got clients short Tesla, and I think that Tesla is late in stage 3, and if it breaks down and closes below, I'm going by memory, below 539, closing below 539, it's going to migrate from stage 3 into stage 4. I also see some early preparatory rolling over in some of the restaurant stocks. For argument's sake, like the Chipotle, CMG, that's also rolling over. It's in stage 3. I've got clients short, but I move in increments. So right now, it's late in stage 3, and if it breaks down and closes below like 1,290, it'll move into stage 4, then you'll hit it harder. So yes, you're right. You don't only want, and if you do your work, and this is where, again, I don't mean to be self-serving. I think that, clients I work with, here's my work can be especially valuable. I do the essence of the work for them because I, along with my staff, I can't do it all myself anymore, but I, along with staff, each weekend, and just before talking with you now, I just sent out my latest weekend update. I've gone through with my staff and I 2,500 charts, and it's kind of like we're Major League Baseball scouts, and I've now narrowed it down to, here are some of the worst looking, which from a shorting point of view is best looking, potential short candidates. Here are some of the best stage 1 and stage 2 long ideas. And so I now, after going through 2,500 charts, are focusing your attention on here are the best minor league prospects, which if they break out above or below the respective levels, depending if you're long or short, can turn into major league superstars. And I think that's really what you've got to do.
And in doing this, I'm sure heard a lot of things. As I like to say, there's only Bachelor of Science degrees in this business, and it doesn't stand for Bachelor of Science. So in the BS degrees that you've heard people come up with, what are some of the common myths that you think people should ignore? I'll give you a couple that you wrote down, and maybe you want to expand on these. You said, don't sell because the PE is too high. Don't hold because the PE is too low. Don't hold because the underlying yield is too high, and certainly don't base selling on tax considerations.
You just summed it up. I think those are all very valid points, and they're not just words. When you use common sense, I think each one is valid. First of all, with the PEs, forget it. I've seen people say, I got to buy this stock at such a low PE. If it's stage 4, I've told you know what? In a bear move, cheap gets cheaper. So you don't want to buy it just because low PE. The same way, especially when the concept stops were running, oh my God, a lot of them didn't even have PEs, and if you were playing that game, you would have missed the whole move. So I think the PE stuff is a fallacy. That's number one. Number two, in terms of what you also said about tax considerations, I stress you can't let the tail wag the dog. I've seen so many people say, well, I can't sell that because, it's not long term, whatever. And this is a true story from many a day ago. I remember, oh God, it was like probably late 70s going to early 80s. And at those times, Atlantic City and gaming stocks were hot. And I remember there was one, Resorts International. Oh, it was such a hot stock. Anyway, I remember I used to do a lot of seminars, da-da-da-da-da. And there was this one guy comes up to me and he says to me, he's got Resorts International, but Stan, I own this stock and I see you put a sellout on it. And I said, yeah, so what's the problem? He said, I can't sell it because it's not long term and I just can't sell it. I said, that should be your worst problem. You have a big profit. The government is your partner. I would sell it. Well, anyway, this is a true story. Now I speak at this conference every year because there are a lot around the country we used to deal with those days. Anyway, it was down here in Miami, in fact. I go and I have a tremendous memory thing and recognition of faces. Names, I'm terrible, but I have great recognition of faces. Guy comes up to me at my booth where I'm now signing books or whatever, and he said, hey, do you remember me? And I said, yeah, well, gee, weren't you the guy that had the problem with your resorts? He said, yeah, I don't have it anymore. I don't have the problem. I said, that's great. You sold it? He said, no, I never sold it, and I lost my entire profit, and the stock had crashed. So, I mean, to me, it's ridiculous. You can't, as I said earlier, you can't let the tail wag the dog. You just have to see. I'm not talking about every wiggle and jiggle, but you have to see what makes sense. And if the worst that's going to happen is you're going to have to split with the government, that's the way it is.
Yeah. Yeah, right. Exactly. Well, now that liability turned into an asset, he's got a tax credit because he can use that loss to offset the other gains. So,
you sound like a great accountant, Jeff.
Oh my. In your 50 plus years, what do you think gets underutilized? Whether it's a market indicator, whether it's oscillators or, simple trend following, what do you think people has such efficacy and yet people don't give it enough credit? Does anything stand out to you?
Yeah, I think my concept of stage analysis. Now, understand, nothing is perfect, but this is wild because, again, I'll never name names, but I have a lot of clients, and some super bright guys and gals, and they've gone to Wharton, and they've gone to Ross Business School, they've gone to Harvard Business School, and it kind of violates their sense of all that they are about to think that, gee, something as simple as my stage analysis can turn out to be more right than the models that they have their underlings take a week to work on, and then we'll come up then with opposite answers. They're bullish and I'm bearish. So I think that those that are really successful learn at the minimum, just like with a football team, you need a good offense, you need a good defense. Forget that I'm 100% technical. But they who really are successful learn to play offense and defense, and if they at least make technical analysis and my stage analysis 50% of their game, and those that tie it in with their fundamentals, because I'm not an anti-fundamentalist, I just think fundamentals lack timing, and they will often come up with great ideas that they'll lay on me, and then I'll start following it, and I'll go, oh, now it's 6 months since they gave me that idea, and we'll talk about it. I now see it coming to fruition. So that's where you can really, I think, put technicals and fundamentals together. But those that don't want to learn just how important it is because they say, oh, it's too simple. I mean, that can't be, and it violates all of their terrific studying at Harvard or whatever. I think that that's a big problem, And I think it comes down to ego. As I said earlier, and it's true, we all have an ego, and trust me, I have an ego. But I know not to believe my own BS. If the market doesn't agree with me, I'm ready to be out of here. And you've got to learn to control your ego. I think that's one of the things that really tactically hurts a lot of great market players.
I think there's a couple things on that. One would be return on invested time, right? So many people spend so much time going through things and they just feel like, okay, I put all this time into it. I sort of need to be right to justify the time. And you and I look at it
exactly
and say, sell it. Like, what do you mean? You just looked at it for 5 seconds, maybe. And you're telling me I put 3 weeks into this and you're telling me to sell it, right? And so I think there's definitely a part of that in this business, which is always challenging. And you're the same way, a little bit more mercenary in terms of it just is what it is. And it's a contract killing. And we do it without emotion or the baggage that comes with some of these things. And to me, that's obviously, I think of it as more of an asset than a liability, but it's not seen that way.
It comes to mind a great quick story I'm going to tell you. True story, but it just puts the exclamation point on what you just said. We have 5 grandkids. Oldest one, she's dynamite. Her name is Sydney. She's tremendous. Anyway, she's 27 years old. But anyway, interesting thing, when she was maybe like 9 or 10 years old, in those days, Sydney and I had an every Tuesday Grandpa and Sydney Day. I had taught her a little bit of charting. She knew a good chart from a bad chart. She used to just mark them up yes and no, whether they were good or bad. But anyway, so one day, this is a true story, she's sitting at my desk, and before we're leaving for the movie, I said, you're great, I got to talk to this client, then we'll go. Anyway, it turns out it's the head of the company. So I'm talking to him. Well, obviously, he knows his company. So anyway, he asked me about, well, what do you think is going on now? And I put up the chart, and it's rolling over, breaking down into stage 4. And Sydney says, Grandpa, and I hit the mute button. She says, tell him that's a terrible stock. I said, Sydney, shush, don't say anything. I said, don't say anything. It's his company. Anyway, she said, okay. And she doesn't say anything else. She says, that's terrible stock. Anyway, I go back, and he told me about, oh, so now what do you, I said, it's rolling over. I think that you got a problem there. He said, no, we're going to be reporting terrific earnings, this and that, whatever. It doesn't matter. 2 or 3 weeks later, the stock breaks down. They smash the heck out of it. And I'm thinking to myself, here's a 10-year-old kid who turned out to be more right than the CEO of the goddamn company. That, to me, was the exclamation point of what you were saying.
With inside information, and there's nobody had more information than he did about the prospects of the company.
Right. That's why people don't understand, like, you're not going to make money if you listen to the talking heads on TV or you read the Wall Street Journal. Come on, you got to do your homework the proper way.
Stan, if you weren't doing this in terms of a career, what do you think your alternate career would have been?
That's very interesting. It would have to be something with numbers, since I love statistics, and I've never really thought about it. I guess, well, this is interesting. Back in high school, many a day ago, I had an English teacher who told me, Stan, you're a terrific writer. You should be a writer. Okay, so that was one thing. I obviously didn't listen to her. Then when I went into college and we had debate, and I was in debate, and I had a different teacher who said, you're a very good debater, and I really think you would also be a good teacher because you explain things well. So now that I think about it, I think that I sort of turned out in the right frame of mind because I write nonstop for clients, and I really think that I'm sort of a teacher. I've got a lot of people that I've mentored. This is a true story, especially when I had the tape reader. I had people, I remember one letter this woman wrote, I can still see it now, a woman from Ohio wrote and said, Stan, you changed my life. You're a hell of a teacher. So I guess that I ended up being a teacher and a writer, but I got paid a whole lot better.
That's fantastic. Well, let me thank you for being, at least from what I know, a teacher. And I did enjoy your book. And I think it really brought, again, Edwards and McGee into the latter part of the 21st century. And by identifying and classifying the stages, you really created a template from which we've all benefited. And that's certainly true from a professional and an amateur standpoint. So thank you so much, Stan.
Hey, my pleasure. You're very kind, and thank you.
I didn't know Stan or much about his work before we talked, but we become fast friends and drink from the same cup philosophically. His stage analysis was a refreshing addition to the work Edwards and McGee did almost 90 years ago. While Secrets for Profiting from Bull and Bear Markets is 33 years old, it remains as relevant to anyone who sees the advantage of trend following and improving the probabilities for success. technician, fundamentalist, or quant. Let the market confirm the narrative. It's critical for success in this business. Thank you for joining us for this episode of Legends. We understand your time is valuable, and we hope you were able to take something away from today's conversation. For all of us here at RenMac, take care.